Hi, I'm Chris Clark with LandElevated.com, and today we're going to talk about the acquisition process. So once you've got the piece of land that you want to purchase and you're ready to go, and you've agreed on the price and the terms with the seller, then you're ready to move to the contract. Now, before we talk about a contract, all you really need to do to make a sale or to make a purchase is you really just have to have two parties that are willing to work together to consummate a transaction. So if you're going to be buying something like a coffee mug or you're going to be buying a can of soup at the store, I mean, you don't sign a purchase contract or anything like that with the supermarket or with anyone that's, at the supermarket. You really just need to hand over the money and take the goods. It's very simple. But that being said, with a piece of real estate, it's a much larger purchase in most cases. I mean, we're talking about thousands of dollars, maybe hundreds of thousands of dollars, maybe into the millions. It just depends on what you're buying. But in the case of real estate, a purchase contract is a really good idea. And a purchase contract accomplishes a few things at the highest level. It identifies the piece of real estate that's being sold. And two, it identifies the parties involved, so the buyer and the seller in most cases. The other thing that it does is it protects those parties. So if you have a really good contract, the contract will lay out the scenarios at play that are going to be going on during the transaction and what's going to happen throughout each scenario. So we'll talk about, for the purposes of this video, we're just going to talk about two types of contracts, and this is really for vacant land. If we were going to talk about all of the types of contracts in real estate, there's courses that are taught to that are long legal courses. So we're not going to dive into that. We're just talking about vacant land here. And we're really talking about vacant land that you can buy for not in the millions of dollars, not super complicated transactions. We're talking about the most basic vacant land. So the two types of contracts that we'll talk about in this video are a cash contract and a term sale contract. So with a cash contract, it's really just what it says. It is for a cash sale. And a cash sale doesn't always necessarily mean it's directly cash at closing, but it does mean that the seller is going to get paid in full at the time at closing. They're not going to receive the sale price. They're not going to receive that in monthly installments. They're going to receive it in one lump sum. So with a cash sale contract, you usually have one contract for that. It's usually a lot shorter. There's less pages to it. It's very, very simple. And it says, hey, here's the buyer, here's the seller, here's the piece of property, here's the amount, and here's the date that it's going to close. That's it. The other type of contract is a little bit longer and it has more pieces to it, and it's a term sale contract. So with the term sale contract, that is in the sale of vacant land. That is when the seller is willing to take payments for the property over an extended period of time. So it works like a purchase contract with also like a loan contract attached to it. And most commonly you'll hear this referred to as a land contract. You may hear other terms like an installment contract, contract for deed. There's various terms out there that are used to identify a term sale contract, but really it means that you're going to be buying the property on terms. There's going to be terms of the loan. The seller is willing to accept payments for the property over an extended period of time, and they're not going to receive that lump sum of cash. So with the term sale contract, that is going to be a little bit more involved. It's going to be a longer contract, and it's a very common type of contract in the sale of vacant land. So once you've got your contract, once you've got the method that you're going to be buying the property, whether it's cash or terms, then you've got to put the contract together and identify the moving parts of that. So once it's signed, then the next step is to work towards closing the deal. Now, there's a couple ways that you can close the deal commonly in real estate, and they are with an escrow company or without an escrow company. Now, an escrow company is a third party to the transaction. They're like a neutral party, and they will hold money that is going to be involved in the transaction, and they will release the money to the appropriate party based on the stipulations of the contract. So for example, with a cash sale contract, they'll say, okay, it's the closing date, and the seller has sign the deed, and the deed is in the hands of let's say that it's going to get recorded. So once they've identified that those things have taken place, then they may be holding the funds, the money that's supposed to be paid from the buyer to the seller. They'll be holding those funds, and once that stipulation is met, the escrow company will then release the funds to the seller. Now, escrow companies are really common when it comes to buying homes. When you're buying a home, there's usually a lot of money on the line, hundreds of thousands of dollars, and there's a lot of contingencies. There's a lot of moving parts with a home sale contract, because when you're looking at buying a home, there's usually going to be a contingency for the inspection, so the property's got to be inspected, and then there's also going to be a financing contingency, because a lot of times, in most cases, people are buying a home and they're getting a mortgage on the property, and the bank's got to approve the mortgage, and the financing has to be a contingency as part of the deal. So when you're buying a home, a person will put up some money, a buyer will put up some money, it'll go into the hands of the escrow company, and then the escrow company looks at the contract, and they basically use the contract as a big sort of if-then scenario worksheet. So they say, hey, if this property passed the contingency for the inspection, and it passed the contingency for the financing, and we've got, say, a $5,000 that we're holding for these contingencies, and then the buyer backs out, well, the escrow company will then release that earnest money deposit of the $5,000 to the seller as liquidated damages. And but on the other hand, if a contingency doesn't pass, let's say that the buyer puts down $5,000 for earnest money, and the contingency for the inspection isn't removed by the buyer in time, and they cancel the contract, well, the escrow company is going to look at that and say, well, the first contingency was not released by the buyer, so we're going to release these funds back to the buyer. Now, there's a lot of different scenarios that can play out with escrow and with home sales, because there's just more moving parts. With land, it's a little bit more simple. I mean, in some cases, you may have some contingencies for land. If you're buying a big piece of commercial real estate, and you need to make sure that you can build a gas station on it, or whatever it might be, you may have soils tests, you may have survey, it just depends. But if you're buying a residential lot, a lot of times you don't need to do any of that stuff. You just need to, I mean, the GIS sites with counties these days, they identify the boundaries of the property, they're pretty accurate. You don't need to put a lot of contingencies in place, if any, with vacant land. So the other method of closing the deal is just to go without the escrow company, and you close directly with the seller. With a cash sale, really easy. You know, you got the deed, you get that signed by the seller, you transfer funds, the deed's recorded, it's pretty much a done deal. With a term sale, it's a little bit, there's even less risk, because with a term sale, as the buyer, you're only agreeing to provide a down payment for the property, and then the seller is then going to be receiving payments. So the property is usually used as collateral for the deal, and you don't have to close until the very end of the transaction officially, because the deed's going to stay in the seller's name in most cases. So with a term sale, you really don't need to use escrow in most cases, because there's not a lot of money on the line, and there's no contingencies. You have full use of the property, and you can build your home, you can do all of these things with the property. So there's no need to, I guess, spend the money on escrow and complicate the deal in that case. So those are the two types of contracts that we'll talk about in this video. Those are the two ways of closing the deal. There's a lot more moving parts with other types of real estate, but for vacant land, it's pretty simple. So if you like this video, comment below if you have any other questions. If you want to watch any other videos that we have online, or get information about other parts of buying vacant land, check out landelevated.com. Thanks so much for watching.